Imagine this. Two of America's biggest banks, JP Morgan and Bank of America, suddenly pull out of a massive Chinese IPO. Not in New York, not on Wall Street, but in Hong Kong. No headlines, no press conferences, just a quiet, almost invisible move that sent billions of dollars shifting across the globe. From the outside, it might look like a normal business decision, but the reality is far more dramatic. This was a bold signal from Washington. The United States was willing to extend its financial power beyond its borders, influencing markets halfway across the world without firing a single shot. China's reaction? Silence. No angry statements, no threats, no media blitz. Just an eerie calm, like a giant chess player waiting for the next move. And then, quietly, capital started moving. Billions in U.S. debt began to be sold off without warning. No alarms, no public outcry, just a strategic, calculated exit. What does it mean when money starts moving before words are spoken? What does it mean for the global financial system when the world's two largest economies start testing each other in silence? This is where our story begins. A quiet financial war, one transaction at a time, with stakes higher than most people realize. At the center of this quiet financial earthquake was a single IPO on the Hong Kong Stock Exchange. The company was CL, a Chinese manufacturer of lithium-ion batteries, essential components for electric vehicles and energy storage systems. On paper, it seemed like a normal tech listing. A projected $5 billion valuation, strong demand from investors across Asia, and support from major underwriters, including JP Morgan and Bank of America. But this IPO wasn't just about batteries. These weren't ordinary products. They were strategically important technologies that could power the next generation of Chinese innovation, including defense and national security applications. That made Washington nervous. On March 27, 2025, the U.S. National Security Council quietly flagged the deal as a potential risk. They feared that CL's technology could one day support China's submarine fleet and other sensitive programs. It wasn't a domestic listing, it was happening in Hong Kong, but Washington decided location didn't matter. Within 48 hours, both U.S. banks abruptly pulled out. The impact was immediate. CL's valuation dropped by $210 million overnight. Investors were rattled, but the message was bigger than the numbers. Washington had signaled that American financial power could reach across borders, enforcing national security priorities on foreign markets. This wasn't just an IPO anymore. It was the first move in a larger, invisible game of financial chess. The CL IPO wasn't just a financial decision, it was a strategic maneuver. Washington was testing a new kind of power, using money itself as a weapon. Experts call it extraterritorial capital deterrence. Simply put, U.S. financial firms were no longer just profit-driven. They were being told to align with national security priorities, even if it meant walking away from billions in potential revenue. Supporters argued this was smart containment. If U.S. institutions continued funding CL, they could inadvertently strengthen China's technological and military edge. Pulling out wasn't just about Wall Street, it was about the long-term balance of power. Critics, however, warned about the consequences. Forcing private banks to follow political directives risks undermining Wall Street's credibility. Investors start questioning whether American markets are open and predictable. When politics overrides profits, the U.S. could lose its competitive edge in global finance, making its own institutions less relevant in international markets. In other words, Washington had taken a gamble. The move was bold, visible, and aggressive, but it came with risk. And as the dust settled, the world began to notice that America's financial influence wasn't just about dollars, it was about control. While Washington made headlines, Beijing stayed quiet. No angry speeches, no threats of retaliation, just action. Within 72 hours of the CL IPO pullout, Chinese state banks and sovereign wealth funds began quietly offloading U.S. treasuries. In the first quarter of 2025 alone, China cut its holdings by $78.5 billion, the sharpest quarterly reduction since 2016. But this wasn't a panic move. It was a carefully planned strategy. China wasn't trying to crash markets. It was repositioning. Money flowed into non-dollar assets like gold, yuan-denominated debt, Japanese government bonds, and regional infrastructure projects. Every sale, every purchase was precise, almost surgical, sending a clear signal. China could move its capital without disrupting global markets, and it didn't need to shout to be heard. This silent strategy created tension in global finance. Unlike the US, which used public pressure and visibility, China leveraged subtlety and patience. The contrast was striking. Washington's loud, aggressive move versus Beijing's quiet, methodical shift. The question now became, who really held the power? The one making headlines, or the one quietly moving billions behind the scenes? China's quiet moves sent ripples across the global financial system. U.S. interest rates began creeping upward, not because of inflation, but because America's largest foreign creditor was slowly stepping back. With less foreign demand for treasuries, borrowing costs for the U.S. government started to rise, tightening budgets and straining public finances. The impact didn't stop there. Forced liquidation and reduced market liquidity created volatility that Wall Street hadn't seen in years. Investors suddenly faced a new reality. U.S. debt, once considered the safest asset in the world, was now vulnerable to strategic maneuvers by foreign powers. Confidence wavered. Portfolios were stressed. And this was just the beginning. Other nations were watching closely, taking notes on China's methods. The financial domino effect was spreading quietly. Capital flows were being reshaped, risk calculations were shifting, and trust in the old system, the U.S.-dominated global financial order, was slowly eroding. In short, what looked like a single IPO disruption had turned into a worldwide recalibration of risk, strategy, and influence. The game was no longer about politics or headlines, it was about who controlled the movement of money. While Washington reacted loudly, China was building quietly, but at a scale that could change the rules of global finance. In early 2025, China's Central Financial Commission committed $423 billion to develop domestic financial infrastructure. The plan wasn't just about more banks, it was about creating a self-sufficient ecosystem: bond underwriting, cross-border settlement systems, fintech platforms, and new credit rating agencies that could operate independently of Western influence. Emerging market companies were taking notice. The Shanghai International Board, China's answer to NASDAQ, saw $112 billion in new foreign listings in just the first quarter of 2025. Companies that might once have gone to New York were now choosing Shanghai, attracted by stability, lower geopolitical risk, and access to capital without the uncertainty of U.S. oversight. Regional cooperation strengthened this system. BRICS banks, sovereign wealth funds in Asia and the Gulf, and even nations like Saudi Arabia began participating in yuan-denominated bonds and transactions. A $4 billion yuan bond from Saudi Arabia was oversubscribed 4 times over, with buyers from India, Brazil, and Egypt lining up. China's strategy was clear: build speed, resilience, and independence. While the U.S. argued and imposed pressure, China was quietly constructing a parallel financial network, one where capital could flow freely without being tethered to the dollar or Wall Street. The world's financial landscape is quietly transforming. China's moves aren't isolated. They're part of a larger shift away from dollar dominance. According to IMF data, the U.S. dollar's share of global foreign exchange reserves fell to 57.4% in early 2025, its lowest point in 28 years. Non-dollar transactions are surging, and other nations are taking notice, increasingly diversifying their reserves and investments. This is more than statistics. It's a structural change. Emerging markets now have alternatives to Wall Street's channels, reducing reliance on U.S.-controlled systems like SWIFT. BRICS nations are building their own payment networks, and regional financial hubs are growing stronger. Each yuan-denominated bond, each regional settlement, chips away at America's traditional influence. The implications are enormous. Where once U.S. policy and capital flows dictated global outcomes, now Asia is stepping into a leadership role. Washington can still react and legislate, but the pace and scope of China's parallel system suggests the U.S. may already be losing control. The power isn't gone yet, but the center of gravity is clearly shifting. History may remember this as the moment global finance became multipolar, moving from one dominant hub to a world where influence is shared, diversified, and no longer solely determined by Wall Street. The story comes full circle. Washington made a bold, visible move by pulling U.S. banks out of a single IPO. China responded quietly but decisively, shifting billions in capital, building infrastructure, and creating a financial system that doesn't rely on the dollar or Wall Street. The result? A global financial order in flux, with power subtly but unmistakably moving east. The question now is bigger than any one IPO, bond, or Treasury note. Is the world still following America's lead, or is it already halfway out the door? Nations are diversifying, emerging markets are seeking alternatives, and China's parallel system is gaining momentum. The game of global finance has changed, and speed, strategy, and foresight are now more important than size alone. So, what do you think? Will the U.S. maintain its dominance, or are we witnessing the rise of a new financial era centered in Asia? Drop your thoughts in the comments. If you found this breakdown insightful, hit the like button and subscribe for the next deep dive. Because one thing is clear, the quiet moves of today could redefine the world's financial map tomorrow.